In Chapter 16, we looked at how costs flow onto the income statement and the balance sheet. But remember, those costs came from somewhere. In chapters 17 and 18, we're going to look at where the costs came from for manufacturing firms. Most manufacturing firms think of their work either in terms of job order costing or as process costing. A manufacturing firm that chooses to use job order costing does so because they think of their work in terms of discrete jobs with a clear beginning, middle, and end. Nobody tells a firm that it has to use job order costing. Managers in the firm choose this method because they know that each job is different. So it's important to be able to trace costs to each specific job. That way, managers can determine how much it costs to make the units in that particular job, which differs from all of the other jobs that the firm might be working on. So, for example, a firm that makes office furniture would choose to use job order costing because it probably makes a wide variety of different kinds of desks and chairs and bookshelves that demand different manufacturing costs from the firm. If job 1 consists of a bunch of a particular model of desks, the materials and labor and overhead that are needed for that specific model flow into the manufacture of those units. And when the units have everything that they need to be complete, they leave the production floor and are moved to the finished goods warehouse. Meanwhile, the firm may also be working on job 2, which happens to be a particular kind of office chair. So the materials and labor and overhead needed to make those chairs flows into job 2. And when it's done, the job leaves the production floor and the units are moved to the finished goods warehouse. At the same time, the firm may be working on job 3, a specific model of bookshelves that need materials, labor, and overhead that are unique to that model. When the bookshelves have gotten everything that they need to be complete, then they're transferred to the finished goods warehouse. Notice that in job order costing, there's no interaction between the various jobs. Each job gets what it needs that is separate from what other jobs might need. And the cost of a particular desk or chair or bookshelf would be its share of the costs that went into that particular job. Some firms don't think of their work as discrete jobs. Instead, they think of their manufacturing as an endless stream of very similar units. So it makes more sense to trace the production costs to the processes that are used to make those units. For example, to a firm that manufactures paint, it doesn't matter if the firm is currently making blue paint or green paint, indoor paint or outdoor paint, semi-gloss or matte finish. The process of making the paint is identical. Production starts when the materials, labor, and overhead needed to make the paint are sent to the first process, the mixing department. When the paint is all mixed, it's transferred to the next process, the canning department, where more materials and labor and overhead are added. When the paint is finished being canned, it's transferred to the next process, the packaging department, where other materials and labor and overhead are added. Now the paint is finished, so it's transferred to the finished goods warehouse. Notice that for a firm that chooses process costing, all units have to go through the same basic set of processes. So the cost of each unit would be its share of the costs that it went through in each process during its manufacturing. Here's a question to consider. If you were a manager at an advertising agency, would you expect the firm to use job order costing or process costing? Think about it for a moment. You probably wouldn't want the firm to use both methods because each method tells a different story about what happens in the firm. So trying to tell two different stories would give you some very confusing information. And you wouldn't expect the firm to use process costing. Process costing is based on the idea that all units, in this case advertising clients, go through exactly the same steps, and that's probably not true. An advertising agency should be using job order costing. Each client is a separate job, and each client needs different things from the firm. Some clients are interested in print advertising. Other clients want television spots. A client of an advertising agency wants the services that are uniquely appropriate for that customer's needs. So job order costing would be the right method to choose. What about a firm that manufactures cell phones? Should it be using process costing, job order costing, or both methods? Again, both methods is probably not the right answer because they tell different stories. And job order costing, isn't the right answer. A firm may make lots of different models of cell phones, but they are all essentially the same in terms of what they need from the firm. So a cell phone manufacturer should probably use process costing because every cell phone, deluxe or basic, needs a circuit board, needs a memory chip, needs some wiring and a battery and a case. So the process of making a particular model of phone is the same as making any other model of phone. We've looked at how job order costing and process costing are different, but they are the same in one way, and that is each method goes through the same 4 steps to track production costs. The first step is to accumulate all of the production costs for the period. The second step is to determine how the direct materials and direct labor were used. Remember, these costs are traceable. That means that we have good paperwork so that we know where these costs went. The third step is to allocate the manufacturing overhead. Manufacturing overhead is not traceable, so we are going to have to find a different way to determine how much overhead was used by the various jobs or processes needed to manufacture the firm's goods. Finally, at the end of the period, we need to check to make sure that our allocation method has properly assigned all of the overhead costs that the firm actually incurred. The rest of this chapter focuses on job order costing. We will be talking about process costing in Chapter 18. Let's look at how we accumulate costs in a job order firm. These T accounts are a good way to understand how costs flow through a firm's accounting system. Manufacturers think of their production costs in 3 main categories: raw materials, labor, and manufacturing overhead. Raw materials includes all of the physical stuff that the firm might need in its factory. It could be stuff that actually will become part of the products that the firm makes, or it could be other things that the firm might use. This account is an asset. That means that it increases on the left or debit side when the firm acquires more raw materials, and it decreases on the right or credit side when the firm uses some of those raw materials. A debit balance in raw materials at the beginning of the period simply means that the firm had acquired some raw materials in the past but hadn't used them all by the end of last period. So they are available at the beginning of the current period. During the current period, the firm purchases more raw materials, which increases the debit balance in this account. Altogether, the raw materials beginning balance plus all of the purchases during the period equals the raw materials that are available for use. You can think of this labor account as sort of a temporary asset. You'll never see it on external financial reports because labor is created and used at the same time. There's never any left over to go into the next period, but it does behave like an asset because it increases on the debit side with our workers' time at work and the dollar value of that time. And it decreases on the credit side when we determine what that work was used for. Manufacturing overhead is another temporary asset. It increases on the debit side when the firm accumulates manufacturing overhead costs. But all of those costs will be used for something during the period. So in the accumulation phase, manufacturing overhead includes the rent on the factory and the utilities that are used in the factory, depreciation on the factory equipment, insurance, and any other costs associated with having a factory. In addition, certain raw materials are taken out of the raw materials inventory for use around the factory during the period. These indirect materials might include cleaning supplies or light bulbs or repair parts or paper towels that never become part of the products that the firm makes. Or they might also include things like paint or glue or staples that actually do become part of the products that the firm makes, but not in a way that the firm cares to measure carefully. When indirect materials are used in the factory, their cost is removed from the raw materials inventory and it's added to the manufacturing overhead account. Similarly, indirect labor, the dollar value of our workers' time when they're not specifically engaged in manufacturing a particular product, is also removed from the labor account and sent to manufacturing overhead. While costs are being accumulated on the debit side of the raw materials, labor, and manufacturing overhead accounts, they're also being used for production. In a job order firm, as production costs are used, they go into work in process. This is an asset account that increases on the debit side when costs are added to production, and decreases on the credit side when the production is complete and the goods leave the factory floor. A job order firm may be working on several different jobs at the same time. As direct materials are added to each of these jobs, that increases the value of work in process and decreases the value of raw materials because the materials are being used. The dollar value of the materials that are used for each job can be traced because the firm has paperwork to show what materials and how much of the materials were put into each job. The same thing is true for direct labor. We can trace the direct labor costs to the various jobs in work in process because we have paperwork that shows us who worked on each job, how many hours they worked, and what their wage rate is. Manufacturing overhead also has to be assigned to the various jobs that the firm worked on during the period, but it can't be traced. There's no way to know for sure how much of the firm's rent or depreciation or utilities or indirect materials went into each job. So we'll use a different method called allocating, and we'll see how to do that later in the chapter. Here's our T account for work in process with all of the jobs that the firm worked on during the period, and each of these jobs contains all of the costs and all of the materials, labor, and overhead that was used on that job during the period. Now the question is, what happened to each of these jobs? There's only two possibilities. Either a job got finished and left the production floor, or it didn't get finished, so it would still be in work in process at the end of the period. In this particular example, job 11 got finished. So we reduce the value of work in process by all of the costs that are in job 11 and debit that amount to finished goods. This has the effect of eliminating job 11 from work in process because it's not there anymore, and increasing the dollar value of finished goods. Finished goods is an asset. It increases on the debit side when jobs are finished, and it decreases on the credit side when finished units are sold. In this example, job 10, which was already in finished goods, so it must have been made before this period, was sold in this period. So we credit finished goods for the value of job 10, and we debit that amount to cost of goods sold. This has the effect of eliminating job 10 from the finished goods inventory. It's not there anymore. We shipped it to a customer. and it increases the value of cost of goods sold. Cost of goods sold is not an asset, it's an expense. It's a negative component of the firm's stockholders' equities. But like assets, it increases on the debit side when we sell stuff, and it only decreases on the credit side at the end of the period when we close it out. But remember, whenever a firm sells goods, there are actually two transactions that are happening simultaneously. One transaction is the one that we just saw. We recognize that we don't have the goods anymore, and those costs of the goods are transferred to cost of goods sold. But the other transaction is a recognition that we earned sales revenue and that we either received cash or we will receive cash in the future, which would give us an account receivable. Cash and accounts receivable are both assets. That means that they increase on the debit side and decrease on the credit side. Sales revenue is a positive component of stockholders' equities. That means it increases on the credit side whenever a sale is made, and it only decreases on the debit side at the end of the period when it's closed to retained earnings. The difference between sales revenue, what the firm earned by making these sales, and cost of goods sold, what it cost the firm to make the goods that were sold, equals gross profit for the period. This is the end of Chapter 17, Part 1.